Good morning. It's me again, Kenny Polcari, your host of the party, and today is Tuesday, July 5th, 2022. After the long holiday weekend, what do we have to look forward to this weekend? There is plenty on the economic calendar. So what is it that you need to know? Well, according to the Atlanta GDP, the U.S. is in a recession. Or at least that's what they're telling us we are. Washington, though, has a different take on it. 10-year treasuries are confirming. What will the Fed do now? Big economic data this week, and next week begins the beauty pageant, right? The second quarter earnings season. And what are we having for dinner tonight? Well, we're having the grilled sweet sausage with peppers and onions. And there's a trick here because you can have it a number of ways to give you a number of different meals. Okay, so last week, Friday, July 1st, 2022, what would stocks do in the new quarter? Would they continue down the path of least resistance lower, or would they try to find support and begin the second half of the year on a positive note? Eco data on Friday revealed that U.S. manufacturing PMIs remain steady, although at lower levels, but they haven't entered contractionary territory yet. S&P Global PMI, manufacturing PMI came in at 52.7, while the ISM manufacturing PMI came in at 53. Weaker than last month and weaker than the estimate, but still in expansionary territory. Remember, 50 is the dividing line, right? Anything north of 50 is expansionary, anything south of 50 signals contraction. The Atlanta GDP Now forecast got revised yet again for the second quarter, and that was not pretty at all. Recall that on Wednesday last week, it first entered negative territory, moving from 0% growth to negative 1% growth. And then on Friday evening, it got revised yet lower again, going from negative 1 to negative 2.2% second quarter growth, making the second quarter of 2022 even weaker than the first quarter, which came in at a final read of negative 1.5%. Let me remind you, it started the quarter at what some thought was going to be a positive 2.2% growth rate. All I can say is, well, at least they got the 2.2% correct. They just had the wrong direction, right? This sent Treasury yields plunging as money moved into the safety space, sending prices of treasuries up and yields down, right? Recall that inverse relationship. 10-year treasuries ended the day yielding 2.87%, well below the 3.25% that we saw only a couple of weeks ago. The fall in Treasury yields helped to support stocks. As the thinking goes, weaker economic data means that the Fed will not be able to be as aggressive and, in fact, could become dovish. So now the focus turns to the July Federal Open Market Committee meeting on the 26th and 27th of this month. And many asking, what will they do now with all this new data? Recall that the week of June 8th, last month, investors awaited the Friday, June 10th CPI report. Recall that the chatter started to suggest that the report was not going to be as benign as the Fed wanted us to believe, causing speculation that the Fed would have to get more aggressive and stocks went into a tailspin that week. Do you remember? The Fed, then in a blackout period, unable to say anything directly, leaked that story to Goldman Sachs on Friday evening, June 10th, after we got the very strong CPI report that showed inflation was not peaking at all, nor was it even thinking about retreating. As instructed, Goldman promptly put out a weekend piece that got picked up by the Wall Street Journal for Monday's edition, conveniently, suggesting that the Fed needed to consider a 75 basis point rate hike. The market, which was already under pressure, caused stocks to fall even more, that headline. The S&P fell 12% in 6 trading days. The NASDAQ lost 13%. And the Russell gave up 14% in 6 trading days. And yes, on Wednesday, June 15th, guess what happened? The Fed announced a very aggressive 75 basis point hike and promised more to come as they tamped down runaway inflation. Apparently an idea that they, the Fed, don't understand very well. Remember what Jay Powell told the ECB forum last week. Now we know just how much we don't know about inflation. Not very encouraging from a Fed chair. Then last week's eco data started to suggest an economic slowdown, and now the Atlanta Fed forecasts a fairly negative GDP for the second quarter, and that is getting everyone excited. So now we must decide, based on the latest GDP forecast, are we in a recession or not? Remember, 2 consecutive quarters of negative growth used to define a recession, yet do not expect anyone in D.C. to confirm that today because they're changing the definition to reflect the current times. The last thing they need 4 months before the election is an official recession. Not going to happen if they have anything to say about it. By the end of the day, the Dow had gained 325 points or 1%. The S&P up 40 points or 1%. The NASDAQ rallied by 100 points or 1%. The Russell gained 20 points or 1.2%. And the transports followed suit, rising 135 points or 1%. So everything was up across the board. Utilities, the XLU gained 2.5%. Think defensive. Consumer staples, XLP gained 1.5%. Think defensive. Communications, XLC was up 1%. Community discretionary up 1.8%. Healthcare up 1.1%. Real estate up 1.8%. Financials up 1.4%. Energy up 1.5%. While tech, basic materials, and industrials all added less than 1%. And that makes some sense because some of those other sectors have been really beaten up. So from a bounce, a trading perspective, that makes sense. Subsectors like housing, the XHB, added 3.5%, but remains down 34% year to date. Think lower mortgage rates helping that group. Airlines, the Jets ETF added 2%, remains down 20% year to date, which makes zero sense to me other than for a trade that anyone would even buy the airlines as thousands of flights continue to get canceled and or delayed, and pilots, those that are left, are getting ready to strike. Metals, the XME up 0.5%. The semis continue to get hammered, down 3.5%, taking that sector down 38% year to date on weakening forecasts. Get ready because more to come. Disruptive tech added 3%, and infrastructure stocks gained 1.7% as BlackRock continues to suggest that investors need to hedge their portfolios with ETFs that focus on infrastructure and real estate. Coal stocks, which have been outperformers this year, will surely continue to march higher. Today's Wall Street Journal runs with the headline, "Coal makes a comeback as energy needs grow." The article describes an energy-starved world that has and will turn to coal as natural gas and oil prices spike. The value trade, SPYV, added 1.3%. The growth trade, SPYG, added 0.7. This morning, U.S. futures are lower. Dow futures down 180, SP's down 30, the NASDAQ off by 90, and the Russell is down by 8 points. As noted, 10-year yields are at 2.88% this morning. Investors are making a bet that the country has now entered a recession, and that will cause the Fed to blink. And they'll blink and they'll stop raising rates, or at least slow the increment at which it is indicated they will raise rates. Let me remind you, if the Fed changes course now, they might as well pack their bags and turn the lights off and go home. Yes, the economy is slowing, but inflation continues to be an issue at 8.6%, and that has to be his focus, as he's told us. Oil, which has been erratic over the last month or so, talk of a global recession, caused energy prices to retreat, right? It's traded between $101 and $120 a barrel over the last month, and this morning it's trading right around $109 a barrel, leaving it just above its 50-day trend line. A Norwegian offshore oil workers strike over the weekend in the North Sea is expected to disrupt oil and gas output, and now that is causing oil prices to rise. Output in that region is expected to be cut by 130,000 barrels per day, or 6.5% of Norway's production. Rising gas prices continue to weigh on the minds of consumers, and when a reporter asked Joey how much longer consumers would have to pay these sky-high prices, he responded, "As long as it takes to defeat Putin." Considering that we have plenty of our own oil, that's a curious response from the leader of the free world. Wouldn't you agree? In any event, what else happened? Citibank is now telling us to expect a collapse in oil prices. They have a $65 year-end target, all while Goldman Sachs and RBC continue to suggest $150 and $200 a barrel, and JP Morgan apparently has an even higher expectation. Now, this is going to be an interesting argument because we're all going to sit here and watch which investment bank on the street has it correct. And also over the weekend, Joey tweeted out that putting gas companies on notice, right? In a Twitter message, he said, and I quote, "My message to the companies running gas stations and setting prices at the pump is simple. This is a time of war and global peril. Bring down the price you are charging at the pump to reflect the cost you are paying for the product, and do it now." Almost demanding that people do what he says. And this only reflects the fact that he and members of his administration just don't get it. They apparently don't understand economics at the White House. If you buy something at X dollars and you sell it at X dollars, then you make no money. You can't pay your bills. You'll go out of business. Who's going to pay your rent? Who's going to pay your employees? But apparently that's not important, according to the administration and the White House into Joey's understanding and his tweet. Right. It's a big week for eco data, right? Today's going to bring us factory orders expectations up 0.5%, durable goods up 0.7, capital goods ordered up 0.7. Tomorrow brings us the S&P U.S. Services PMI of 51.6 and ISM Services PMI of 54, both lower month over month. And since the U.S. economy is 75% services economy, this is a key metric. And Friday brings us the all-important non-farm payroll report, and that's expected to show that we restored another 275,000 jobs. And I say restored because we haven't created new yet, right? We need to regain all that we lost before we can honestly say we created new. No? Stocks in Europe are down across the board this morning as momentum fails to build. The Bank of England is due to announce their biannual financial stability report later today, while the European Central Bank is due to announce their latest policy discussion on Thursday. Eurozone services PMI coming in at 53, down from 56.1 in May, suggesting a slowing economy there as well. Although it remains in expansionary territory, the trend is down. I expect more volatility, right? It's a big vacation week this week. We're now in the dog days of summer. Volumes typically retreat and moves can be exaggerated in either direction, which is why portfolio managers leave these good till canceled orders on both the buy and sell side above and below the current market levels to take advantage of any outside swings that might happen as they enjoy the sun and the fun of the beaches, oceans, and lakes across the country. And mountains. Don't forget the mountains. The mountains are beautiful. On Friday, the S&P closed at 38.25, up 40 points. This morning, futures are suggesting a lower open as the path of least resistance remains lower. Look for support at S&P 3600. If we get there and it does not hold, then expect the algos to go into overdrive, sending stocks lower as they try to shake the branches to see who falls out. Next week begins the quarterly beauty pageant. Revisions are all over the place and investors are reassessing the outlook. If we're in a recession, we need to ask now, how bad will it be? How will it be shallow or deep? Will it be long or short? Where can I find safety? What will happen to estimates and forward guidance? Well, hold on, because we're about to find all of that out beginning next week when JP Morgan launches the season on July 14th. My advice is stay focused. This is not the time to get rattled. Continue to put money away in tax-advantaged accounts. You can keep it in cash and be patient if that makes you comfortable. You can continue to put it to work, taking advantage of the dollar cost averaging theme. I remain cautious but not hysterical. Keep the prize in your line of sight. I expect again that we're going to retest and hold S&P 3600 sooner rather than later. But look, I guess it's a big wild card, right? Depending on the stats we get and the conversation and how it goes is going to dictate whether we hold it or pierce it. In any event, what do we have for dinner tonight? Oh, this is so simple and I made it yesterday. I love this. Grilled sweet sausage with peppers and onions, right? It's simple to make. It's always a fan favorite. And here's another secret. Feel free to eat this just as sausage with peppers and onions. Make that and then boil up a pound of rigatoni, toss it all together, dust it with some fresh grated Parmigiana cheese, and boom, you have another family favorite. Okay, so for this, you need at least 6 sweet Italian sausages. You need both green and yellow bell peppers. You can add red if you like to really want all kinds of color. You need 1 large Vidalia onion. You need olive oil, salt and pepper, and a clove of garlic. You want to light your grill, you want to brush the grate and get that ready to receive the sausages. In the meantime, you want to start by slicing the garlic, the onions, and the peppers. In a large saute pan, you want to add some olive oil, heat it up on high, then toss in the sliced garlic, turn the heat down to medium, let it cook for 2 or 3 minutes. Now add in the sliced peppers and the onions, season it with salt and pepper, turn the heat to medium high, saute them until they get all soft and delicious. 15, maybe 18 minutes or so, they'll start to soften up and really, the kitchen will smell. It'll be delicious. Now, go out to the grill, place the sausages on the grill, and begin to cook them. Careful, don't let them burn. Turn the grill down to medium. Once you throw the sausages on there, you want to turn them over every, 3 or 4 minutes. You want to get the grill marks all over the sausages. You want them to cook through. The sausages should take no more than 10 to 12 minutes to cook. Then take them, remove them, bring them in the house, and just let them rest for 5 minutes. Just let them kind of come together and rest. When they're rested afterwards, take them to a cutting board. Slice the sausages into bite-sized pieces. Toss the sausages into the pan with the peppers and the onions. Mix it well so it all marinates and it comes together. Turn the heat down to low, saute it for another 5 to 8 minutes, and bang, you are done. Now, you can eat it this way as an appetizer. You can eat it this way as dinner with a big salad. Or you can boil up a pound of rigatoni and then mix it all together, adding a handful of fresh grated cheese. You want to serve that if you make that in a large white bowl and place it in the middle of the table to serve to your family as family style. Oh, yum. It is so delicious. This dish should cost you about $40. And if you add the pasta, you're able to feed 6 or 8 people, which works out to about $5 a person. Pretty good. No, you can't even do that at McDonald's. Cost you, $11 a head for a cheeseburger and medium fries and a medium Coke. I mean, come on. And this is so much better. In any event, it's a glorious day here in South Florida. It's going to be in the 90s today, but it feels like it's going to be a little bit drier, not so humid. Until tomorrow, take good care.